Good morning and welcome to Don't Run Out of Money. I'm your host Dave Seibel, and today we're going to talk about financing probably your biggest investment. My guest today is Larry Gold. Larry is a licensed mortgage broker, I guess, Larry?
Originator, we go by that name, Originator.
Okay, from Advisors Mortgage, and Larry's licensed to do mortgage in multiple states, here in New Jersey, now in North Carolina, because yes, everybody from New Jersey is moving to North Carolina or South Carolina. He's a 20-year veteran of the mortgage industry, and his greatest passion is to help first-time home buyers get, get their mortgage and get their first homes. Larry, welcome. Thanks for joining us.
Thank you, Dave. Good to be here.
Great. Larry, tell us a little bit. Let's start off just, a little bit about you. Kind of give us, you've been in the mortgage business for 20 years. You're at Advisors now. What sets what you're doing now apart from maybe what you've done in the past, and why are you where you are now?
Yeah, as 20 years in the business. I was in the business when we had our mortgage meltdown about 12 years ago. So that was a major learning experience for me, and I guess for everybody in the industry. Things are a lot different now. It's a much different world today than it was 12 years ago. And I do think that both the consumer and the industry is better off for it. And I'm one of the survivors, and not only have I survived through it, it's actually been getting better every year. Like you said, I've been 20 years in the industry. Over that 20-year career, I've worked for 7 different companies, and I landed most recently 3 years ago with Advisors Mortgage. And I got to say, even though they're my employer, I'm biased when I say they're the best company I've worked for. Their support is second to none, nothing like I've experienced before in the industry, and I'm very proud to hand my license with them.
So, you mentioned something about, the mortgage meltdown. Everybody knows 2008 and, what happened back then. So how are things different, from programs and what programs are offered? We know in 2008, the subprime, basically you could just sign your name, pay an extra quarter point, and say you make $1 million a year and get a mortgage. Obviously that's changed now, but how have the programs changed, and what's available out there now for home buyers?
Well, the main bread and butter of the mortgage industry are conventional loans, which basically Fannie Mae and Freddie Mac guidelines. That's the main bread and butter for the top tier borrowers. But there's government loans that are very effective. FHA is very popular. A lot of people know about that. They think it's a first-time home buyer program. It's actually not, but it's commonly used by first-time home buyers. It's a minimum amount down of 3.5%, and liberal credit and liberal guidelines with income. There's the other government loans would be VA and USDA. VA is a great one for our veterans. They get to buy a house with no money down. There's no mortgage insurance. It's a very good program. And the USDA is also another program that's excellent, but we don't do a lot of it right where my main market, which is Monmouth County, New Jersey right now, because there's not a lot of rural area around here. But out where there's a sparser population, it's a great program for people looking to buy a house. That is for first-time home buyers, and it's zero money down. There also is what you might equate with the subprime mortgages coming back into our industry. They have a different name. They're called non-QM, which means non-qualified mortgages. It's a legal distinction in the mortgage industry, but it's not like it was 12 years ago. We're not fearful that we're going to have a repeat performance of a meltdown, because the guidelines on the non-QM programs are a lot more conservative and reasonable.
So, talking about that, what are the guidelines now? I know there's back, last time I bought a house, the 2834 and all that kind of stuff. But what can somebody, if somebody's looking in and they're thinking about buying a house or buying their first house, how much do they need to put down, and how do they know how much they can afford?
Well, number one, in terms of down payment, with the FHA, like you said, it's a minimum of 3.5% down, but you can do an FHA with more than that. Like I said, the VA and the USDA are 100% financing, so there's no money down there. But the conventional is where you're going to ultimately get your best rates. And with those, people think you have to have 20% down to do a conventional mortgage. It's actually not true. You can actually do as little as 3% down with both Fannie Mae and Freddie Mac guidelines. You're going to have to meet certain criteria such as household income and geographical location in order to qualify for a 3% down program. But it's commonly used with 5, 10, 20% down, and that's when you've got low debt to income ratios and a decent amount of money down.
Yeah, and I think that's usually the problem for most people is now, with, especially around here, when houses, entry level houses are, $500,000. If you put 20% down on a $500,000 house, you got to take a big chunk of change out of your pocket. Now, you talked about handling or dealing with a lot of first-time home buyers. What do you see in the market? Do you see these people that are able first-time home buyers? Well, first of all, let me ask you this. First-time home buyers, what are you seeing as the trend as far as age goes? Because we hear a lot of things about the millennials, that they're not buying houses, or they're not buying houses until much later. And that's why I think every piece of construction you see are, the so-called luxury rentals. So what are you seeing there as far as the age and the demographics of those first-time home buyers?
Yeah, that's a great question, Dave. Actually, recently, about 6 months ago, I was reading some statistics where it was talking about the first-time home buyers and their average age, and it was actually in the early 30s, which is older than the average age was maybe 5 or 10 years ago. We believe that through the tough times over the last 10 years, when the economy wasn't doing so well, that many 20 and 30-somethings were living in their parents' basement. It was always the joke, they're living in the basement. And we believe those folks have been coming out of the basement, and we're seeing that because a lot of them are first-time home buyers, and consequently living at home. Many of them have been able to save up larger down payments, so they've been able to enter into the housing market. But for those that are kind of 20-something looking to buy, there's no question it's a very challenging time. The inventories is the major problem. We do have a lack of inventory, and we also have high migration from some of these cities and states where maybe there's not the management of COVID and so forth hasn't been as what I would say good, and people are fleeing those areas. So we do have high migration, higher than usual to certain areas. In New Jersey here, we have people coming from New York, down in the Carolinas and Florida and Texas also. There's a lot of northerners and people from California moving into those states. So in those areas in particular, it's very difficult, but it's not impossible. That's what I like to tell people. And what I recommend is that they go see a mortgage professional early as possible and get a complete review of their situation. That's something I take a lot of care in doing because I have a heart for the first-time home buyer in particular. I educate my clients and I coach them because there may be potential weaknesses in their borrowing profile, and we address those. Maybe they need to save up a bit more money. Maybe they need to pay down some debt. Maybe they need to get their credit score higher. Maybe they need to talk to mom and dad or Uncle Joe about getting a gift to help them with their down payment. Those types of things. But like I said, it's definitely challenging for those folks, and I've had quite a few buyers that have just they've bidded on several houses and lost, and they basically just hung it up, said we're going to take 6 months off and then come back and look again.
Right. Now, you mentioned a couple of good points there, and you may have just answered this question, but I've always wondered why would somebody, or what are the differences between, say, going to somebody like yourself, where I guess you can offer programs from different places, and walking into, let's say you walk into where you have your bank accounts and you just go talk to the loan officer there. What's the biggest difference between the two different, I guess, channels in the industry?
Yeah, that's a great question, Dave. Thanks. No, I didn't answer that one. My personal recommendation is to stay away from the big banks and the internet companies. Obviously, I'm biased because I work for a mortgage independent banker, but there is reason for what I say, and that is, I noticed with the I don't want to say names, but the large internet companies and the big banks, the customer service isn't what it is, and for somebody buying a home for the first time, they really need to have their hand held. It's overwhelming. They have a lot of questions, and they need to be able to get their questions answered promptly. Also, they're not as nimble. Let's say they're not as quick to respond, and that sometimes their guidelines are more conservative. And if you don't fit in that box, they really, you know, just have a lot more flexible going to an independent mortgage banker. And I also do recommend that you go to your financial planner, your CPA, or your realtor and get a personal reference. I feel that they're going to receive more service because the loan officer is accountable to those referral partners. And so they have
Right.
much more high degree of motivation to provide top service.
Yeah, and that's a really good point. I think that people sometimes, and I won't mention names, but for some reason I've run across a lot of people with mortgages from one specific bank that's had some troubles lately, and no one's happy. They can't get people on the phone. They can't get, they can't get questions answered. It doesn't seem like when you're in that situation that there's anybody to talk to and there's no way to get help. And I tell you, if it's like anything, I've had a week with trying to get people on the phone from different companies, and you end up on the voice response systems, which want to make you, end it all. But I think that that's important when you talk about, in this regard, and even with a lot of other businesses, when you get a referral from somebody, it does carry a little more weight, and the people who are, the receivers, if you will, of the referral, the people who are being referred tend to really want to do a good job, because we all know in all of our businesses how hard it is to generate that new business. So when you do get somebody who's, in essence, dropped in your lap, that there's that special incentive to really take care of that person and get that work done. So that's great. One quick question, Larry. We're going to have to go to a break in a second, but what do you see right now as the biggest challenge facing home buyers?
Well, I think I pretty much covered that recently in the last question, but the greatest challenge is fighting off competition, and let me reiterate it, that's where it's really important to talk to a loan officer as early as possible, because you may need some time to be coached, to be put into a better tier of borrower, and you've just got to find ways to get an edge over the competition, because in many cases there's multiple people bidding on the same house, and in some cases it's not like a house sale, it's more like a house auction, because they're just saying highest and best, give us your highest and best.
Yeah.
And of course, if you're a cash buyer, you're going to be way up there on the top. One thing you can do is bid a little bit higher than the cash buyers tend to want to get a deal, because they're paying cash. Maybe you can separate yourself from bidding a little bit higher and going in higher. So the other thing is, you really need a good realtor that knows your market. If you're being represented by a realtor as you go looking for a house, you want somebody that's got a good reputation in the area, because sometimes that can make a difference. When the listing agent receives the offer, if they know that offer is from a reputable mortgage person and a reputable realtor, they feel a lot more confident in recommending that offer to the seller. That's another thing you can do to separate yourself from the competition. Work with the top professionals in your area.
Yep. Okay, Larry, stay with us. We're going to take a break, a few words from our sponsors so we can pay some bills around here. We'll be right back.
So, I'm kind of new here, but I've noticed a trend. My human does this funny thing where she goes around and gets all my toys, and then she hides them in that basket by the door. But it's always the same basket, and it's always in the same place. And then she acts so surprised when I find them, but, she's putting them in the same basket. Again. It's like, hello, that's where you put it last time. You were the worst at hide and go seek.
Welcome back to Don't Run Out of Money, and we're here today with mortgage banker Larry Gold from Advisor Mortgage. And Larry, before the break, we were talking about the current, what's going on and the challenges in the market with inventory and everything else. And I've spoken to a lot of people lately who were looking to buy houses, and it just amazes me because as an investment guy, I have one hard and fast rule, and that's that you never buy into a feeding frenzy, because eventually the market's going to come back to you. But buying a house is such an emotional thing. How many times have we seen somebody walk in a house and they say, oh my God, this is the greatest house in the world. We've got to get this house. And they go through the process, and maybe they do, maybe they don't, but then they walk into the next one and they feel the same way. But when they're in that house, they got to get it. Do you ever, how do you handle that with clients as far as when when people are getting into these bidding wars? Is it just that they've got an upper end that they're approved for and that's it? Or do you give them any advice when it comes to, the current market, or I don't know if it's still continuing, but where there are bidding wars and how to handle that?
Well, to start off with, when I interview a client initially, I can pre-qualify people in two ways. I can pre-qualify them off of what their comfort level of what they want to pay per month, or I can see what the most money is that a lender can lend them based upon all the factors that they show us in their documents. So the reason I do the first one, I qualify off the comfort zone, is because when I send clients out there to look for a house, I really don't want them buying more than a house that they're comfortable paying.
Right.
And many times I can already see that. I can see in their use of credit and their ability to save money if they're comfortable, if they're stretching it. And I do not want somebody buying a house and going over their head. So when I have a client that's out there, many times somebody starts with, say, a $2,000 a month comfort level, and they go out there to see what's available in their comfort zone. There may be next to nothing available to them. So then they'll come back to me and I'll do a new look with them and show them. Maybe there's other things I can show them. A CPA can show them about the tax benefits of owning a home, where a $2,000 a month payment is probably on a rent is equivalent to maybe a $2,300, $2,500 payment on a mortgage. So we then go into those areas and look at those. So I encourage them to stay with it as long as they're comfortable. Sometimes they're not comfortable, and then the best recommendation is to take a break or look in a different market where maybe the prices aren't as high. The other thing I wanted to address is there's a lot of the education I do involves graphics where I can actually show people if they're nervous. Maybe they can afford to go high, but they don't want to. Mm-hmm. And I'll show them based upon current appreciation, which, by the way, year over year, the national average is about around 16.5% appreciation of real estate. That means the last year it's been appreciating over 1% per month. So if you're looking at buying a house for, say, $400,000 today and you get outbid, if you try to buy that same house in 2 months, you're paying 3% more. to buy that same house. So it's actually costing a client who's serious about buying, it's actually costing them in some cases $2,000 to $3,000 a month not to buy a house. And when you consider what the rental market is like, if you're not buying and you continue to rent, you're really losing money. So that I show them in actual numbers on what's going on with interest rates projected to go up and the continued appreciation on real estate, which we could talk about that later, Dave. That would be a good subject. I show them why smart money is offering over asking. It's not people with money to waste. In many cases, it's smart money because they understand that that is not going to be wasted money, that they're going to get that money back in 1 or 2 months just by appreciation.
Well, that, Larry, that great segue into that topic. There's a lot of people who say that this is, a COVID-induced bubble because you have, especially these bidding wars. I mean, they're there because everybody's trying to get out of New York City and get out of the other places and come down here. We've seen it, my wife and I saw it down in Hilton Head, where everybody from up here was basically moving down there and just buying things sight unseen because they said that we can work remotely for the rest of our lives. And then all of a sudden, which is we're starting to see now, people have to go back to work, and it changes the dynamic. So now where they may have moved to some place where maybe the commute isn't as advantageous, are they going to continue that? So, I guess the question is, do you see this as a bubble? And we've seen other times where, housing prices have appreciated at, a pretty outrageous clip, and then all of a sudden came crashing back to earth. How do you see the market right now and the prospects for the market over, say, the next 12, 24 months?
Yeah. Well, I know there's many industry experts out there that are predicting that we're in a housing bubble. I'm of a differing opinion. I look at what's going on now and I compare it to 12 years ago, and it's quite a different environment. You do have underlying some strong fundamentals. There's plenty of jobs out there. Not quite sure why people aren't rushing back to fill them. That's a whole nother subject that's beyond my pay grade. But the economy basically is strong. The job market is strong, let's say. Sorry, I lost my train of thought. Can we do that over again, Dave?
Well, yeah, we're talking about the market over the next 12 to 24 months. And, you're saying that, there's a lot of industry experts that are saying that, okay, that it's a bubble. And there's a lot of people that are saying, well, no, the fundamentals are strong. So, really the question comes down to is, there's two sides to this, right? One side is you never buy into a feeding frenzy, that we have enough history to look at. The market's going to come back to you, whether it's this year, next year, the year after. And then there's the other school of thought that says, well, we're in an area where inventory is limited. What's being built is apartments and things. And can this, if you're that first-time home buyer, let's say, could this market get away from you for the rest of your life, basically?
Right. Comparing today's environment to, say, of 12 years ago with the mortgage meltdown previously, I feel I'm not of the opinion that this is a bubble. Mm-hmm. The appreciation is very strong, as I just mentioned. It's obviously not sustainable because income and wages will not keep up with that. So that will taper off some of the demand for housing, which will cause some stabilization in the appreciation. I think it's an unhealthy amount of appreciation right now. It will stabilize. I don't believe it's going to crash because the fundamentals are strong. If you look back 12 years ago, the average interest rate was 6%, and they were lending money based upon stated income. So the quality of the loans out there was not good. It's
Right.
different now. We've got much stronger, more conservative underwriting guidelines. So the loans that are out there are with people that can mostly afford to pay them. And the average interest rate is more like 3%. And the income of the average household is up significantly from 12 years ago. So when you look to the debt to income ratio, you'll see that we're not about to have massive defaults on the mortgage. Of course, as we all know, we're living in very uncertain times, but all things being equal, I don't believe we're going to experience a crash. I believe that values will stabilize, and I think it will be a healthy thing for the real estate market for that to happen.
That's so that leads in, and we've got one more question that we got to wrap up. We're running out of time, but you know, one of the things that I've always been curious about is we talked about the millennials before, and we talked about the millennials not buying, and when they are buying, they're more, I guess, conservative. They're not buying a lot that they don't need, right? So let's fast forward 10 years down the road when maybe our kids are all getting out of school and everything else, and we all, in all the areas around where we are, there's this a lot of these McMansions, call them, right, where the prices are just out of control, and the taxes. So how do you see that market going 5 years from now or 10 years from now, when the generation that's coming up that could be the ones that would be buying those don't have an interest in that type of house?
That's a great question, Dave. I hadn't contemplated that, what's going to happen with all those McMansions. I've visited some areas, and I think you alluded to this earlier, that the preferred model for the millennials in their choice of housing is these apartment complexes where they have like the gymnasium, the pool, everything on the ground floor.
Yep.
But I got a feeling that the builders and the real estate market will adapt. Maybe those millennials, when they get older, would like something like that, though it doesn't seem it's their choice right now. I do believe there'll be people that want to buy those homes, and as their families grow and so forth.
Yeah, I guess my feeling is I just don't, I don't own one of them, but if I did, I just wouldn't want to be the last one trying to get out when there's nobody to buy those things. But Larry, I want to thank you. Unfortunately we're out of time. These half hour goes so quickly. But if people want to get a hold of you, people are interested in a mortgage, finding out more, how do they get a hold of you?
Yeah, they can just do a simple internet search. My name is Larry Gould. I'm with Advisors Mortgage. You can call or text at 908-309-3054.
Great. Thanks, Larry. And as always, if you want to get a hold of one of our guests, you can always reach out to me personally, and we'll put you in touch. Larry, thank you very much for being with us today. Very informative. Love to have you back in the future to talk a little more about the housing market and mortgages and things as things change. So thanks again, and thanks to our viewers for being out there, because like I always say, without you guys, we're just talking to ourselves. So until next time, be well, keep smiling, and don't run out of money. Have a great week.